All right, Ben, welcome to the AFWERX stage. We are at the bottom of the hour and ready to kick off into your workshop. So for those of you joining, you've got gallery view and speaker view. Feel free to jump over to speaker view up in the top right-hand corner of your Zoom box. And Ben, we'll turn it over to you and welcome everybody into this workshop.
Awesome. Thanks so much, Tom. I appreciate everyone joining me. So hopefully the day has been going well so far for you guys. I'm going to give a talk on how startups can grow faster with alternative financing. It'll be about 20 minutes or so of just me providing a little bit more of a background, a little bit more about different options in alternative financing, and then who potentially uses this types of financing. And then we'll open it up to questions and answers. So if you guys have any questions during this time, you can just type them into the chat box, and I think Tom will help me put together those questions at the end. So hopefully this will be an informative, short workshop, and yeah, hopefully it'll be interactive as well. I know it's tough given that everyone's virtual, but again, just type in the questions and then we can approach them at the end of the conversation. So first is I want to start off with my background. So after I graduated college, I went into corporate development at Hearst Corporation and then Anheuser-Busch, where I worked with a lot of our smaller vendors. So a lot of these smaller vendors were startups and different companies who had contracts with these large companies like Anheuser-Busch, like Hearst, but they wouldn't get paid on net 90 or even net 120 payment terms. And so that basically means that when they actually fulfilled the order, the startups had to wait 90 days or even 120 days to get paid. And I saw from the corporate side how much pressure and strain this put on the startup side. And then I started managing in a family fund, investing in early stage startups, built up a portfolio of a number of different tech startups. And then I saw from the opposite angle, these different startups, our portfolio companies, working with these large corporations and having to wait the same amount of days, 60, 90, even 120 days to get paid, and the amount of strain and pressure that it put on it from the startup side. So that kind of led me to launch VendorTerm, which is a company that helps kind of this whole situation. So basically what you previously had was that these startups would have these big contracts, these big purchase orders, these big invoices from these corporations, but they wouldn't get paid for those 2, 3, or even 4 months. And so traditionally these startups had to pursue financing in 2 different ways to help finance those POs. They had to either, one, get a traditional line of credit from a bank, but the traditional line of credit from a bank is really time consuming and there's a lot of red tape. So it really takes, even 1 to sometimes even 3 months to get that capital from the bank. And then on the second option, there was traditional venture capital. But as some of us may know, venture capital is very expensive and it's only really meant for a specific type of startup. So, these VCs will take anywhere from 10 to maybe even 30% of your company. And for a lot of startups, they were looking at it as pretty expensive in terms of equity dilution. Then over the past year or so, we saw alternative financing really start to pick up. And alternative financing really started to pick up because a lot of these startups were looking for different options to grow their business instead of the traditional VC or banking route. So now there are a lot of different alternative financing firms offering a variety of different solutions to startups who have POs, contracts, or invoices from large corporations. Some different types of methods. There's one from revenue-based financing, which is where the alternative finance company will take a percentage of the revenue and then you pay them back each week or each month after that. There's invoice financing, which I'll go into further. And then there's also a variety of different methods as well. But what's now really interesting in this whole alternative financing space is as payment terms will continue to increase, a lot of these startups are going to be looking for these alternative options to grow their company in a much faster and non-dilutive way. So as for VendorTerm, I can speak to what we've seen in the market and from our perspective. So, we speak and meet with, or we used to meet with, not anymore, but we speak with probably around 20 or so different startups a week, all in different geographies, different spaces, different fields, and different stages of their life cycle. And so what's really interesting is that, if you're a startup and you're a founder or CEO or COO or even CFO, understanding the different options in alternative finance is going to be really critical to your growth. And now kind of tying it back to AFWERX and the Air Force is that when these companies do have a PO or an invoice that a startup may win and attain, that startup is in a really good position. It's in a lot better position now than it was 2, 3, 4 years ago. There's so many different options as a startup to be able to leverage those accounts receivables for your growth. So what we've seen from our side is a lot of different startups and companies become much more, have a much better understanding as to the options. And then with that understanding also shifts the advantage in favor back to the startup side. So I think from our perspective, we saw VCs have a large amount of power or sway over those conversations, more so a few years ago than today, largely because VC was kind of a take it or leave it option for many startups. And now, due to this proliferation of different options, the power shift is beginning to move back into the startup's favor. So how does invoice financing and invoice factoring work? So it's pretty simple. So let's say that you're a startup and you have a invoice from a large corporation XYZ. And let's say it's $100,000, but they're not going to pay you for 90 days. So as a startup, you're kind of going to weigh, is it worth us waiting 90 days or should we try to get paid faster? And for the startups that say, hey, I don't want to wait 90 days because 90 days to us is an eternity, right? As a startup, 90 days is forever. We instead want to learn how to finance that invoice. So what you'll basically do is you'll speak with a few different options and eventually find one where you'll be able to sell that invoice to that invoice financing company. And that invoicing finance company will say, okay, we'll purchase that receivable from you and pay you a lump sum within a few days. So they may pay you anywhere from $90,000 to $95,000, for example, on that $100,000 invoice. And then you now have access to that 90 to 95K in just a few days. The benefits of this is that you get really fast capital. It's really flexible. You can use it as needed. And then you can also do with that capital whatever you may wish. So you can put it towards operation costs. You can put it towards payroll. You can put it towards rent. You can put it towards marketing and sales. Whatever it may be, you can do whatever you want with that capital. And then fast forward 90 days, that large corporation XYZ, is then paying that invoice financing company directly the $100,000. And that invoice financing company is keeping that difference. So, that $95,000 to $100,000, that 5K difference, they're keeping that as their fee. So for a lot of startups, I think a question that you may want to ask yourself is, do I want to wait those 60 days, those 90 days, those 120 days to get paid? Is it worth it for me? Well, it depends on your startup, what field you're in, the stage, what product you're offering. So all of these different factors need to come into your equation. But I think largely if you're a startup at a certain inflection point and you are signing clients, you're growing really fast, and you don't want to wait, the 60 or 90 days to get paid, it's a really interesting option because you can really accelerate your growth much faster than previously. But obviously with these benefits, there's also costs, right? So that was kind of the upside that I shared with you. But the downside of exploring alternative financing and invoice financing is that first is that it is expensive. So these rates are going to be much higher than obviously traditional bank loans or traditional bank capital. Largely due to then the cost that these invoice financing and alternative financing companies have from their own capital partners. So it is much more expensive. And that's probably the largest downside for a lot of companies. And for a lot of startups who may not have as large margins as one would hope, then sometimes that option just doesn't really make sense for them. That's why from our perspective, we typically see a lot of technology startups, specifically a lot of SaaS startups, so software as a service startups, use our service largely because many of these tech startups have margins that are very high. So you even look in the public markets like the Googles of the world, those margins are extremely high, and that allows them to take advantage of these alternative financing solutions. I'll then move into a typical startup profile who we see using alternative financing. So there's usually a few different types of companies who really fit this profile well. So one is a startup who has either raised outside venture capital or is bootstrapped it to a certain point and is looking to grow much faster because they just signed a large client. And they know that if they can execute on this contract, they can then get future business much faster than having to wait those 60 or 90 days to get paid. So I think a lot of that goes back to that first profile of having a startup at a certain inflection point and saying, look, I just don't want to wait 60 or 90 days. Like time is money to me. I want to get going now. I want to capture this momentum, and I really want to capitalize on this market opportunity that I have right now. So that's kind of the first bucket. And then the second bucket of startups who are really looking to extend their runway. So are doing well, their business is generating revenue, but they're really not either profitable or they're not going to be making a large amount of profit in this year. But what they instead want to do is really kind of just get everything tightened up and put capital towards maybe some operating expenses that they have, maybe expanding the team and the headcount, and that they know that if they can get access to that capital faster, it'll extend their runway an additional 2, 3, or even 4 months, and they can keep their head above water. And as everyone knows in the startup world, you really just have to keep your head above water. Perseverance is key. And so for some startups, alternative financing allows them to, get a little bit of a breather, have some more space for a runway, and then hopefully begin to continue to execute down the road. So as for some examples of deals that we've been looking at recently, alternative financing is really interesting because we look at a variety of different deals and startups. So one morning we'll be talking to a SaaS startup, another time we'll be talking to a healthcare company, and then at the end of the day we may be talking to a fintech company. So really a wide variety of startups, really interesting people as well. We've also seen a number of startups come to us with government contracts too. So for particular, one example I'll talk about is a startup that had a government contract from a large government entity and just didn't want to wait net 60 to get paid. So what they did was they sold their receivable, and then that company purchased that receivable and paid them a lump sum, so they didn't have to wait the net 60 days to get paid from that government contract. As I'm sure you guys have seen with the Air Force and some other entities of the government, a lot of these initiatives are really taking place right now where the Air Force, for example, AFWERX, they're looking for these startups to work with them. They're looking for these innovative new technologies and new startups. And so if you're a startup, it's an amazing opportunity because you have someone who's massive like the Air Force and AFWERX, putting out these briefs and these options for startups. And if you can sign a contract, get an invoice, get a PO, et cetera, there's real opportunity to continue and ramp up that product. Another example that we've seen as well is a SaaS company come to us and say, hey, Ben, we have a quarterly contract from a large corporation, and they basically pay us a 6-figure sum every 3 months. Well, how do we get access to that capital instead of waiting the 3 and 6 months to get paid? So we really help those SaaS companies get access to the capital on the first of the quarter of every quarter, and then they can submit that same invoice to us every 3 months down the road. So for SaaS companies, reoccurring revenue is great, but if you can't have access to it, it doesn't really help you grow. And so what we've seen is a lot of SaaS companies take advantage of alternative financing in that point. So I'll just talk for a few more minutes, then we can move into the questions and answers. So again, if you guys have any questions, just put them in the chat. I'd love to address them. I find that to be more interactive and valuable for you guys. But 2 questions that I want to address first is, why is alternative finance now becoming popular? So I think the narrative of venture capital as a one-size-fits-all option for startups is now becoming less popular. I think shows like the Shark Tank really actually helped alternative finance grow because you had sharks like Kevin O'Leary come in and say, hey, look, I'm going to take a royalty and I'll give you $200K, which you'll pay me back per your revenue, and let's do that deal. And he would be up against Mark Cuban or someone else saying, well, I want 20% of your company. And what I think a lot of people saw was that these really smart startups were saying, I don't want to give up 20% of my company because I have $1 million PO from Costco or from Kroger's. Instead, I'll take the O'Leary deal because I can then maintain my equity, which is my upside, right? Equity is the upside. So I think actually that Shark Tank really helped move alternative finance into the mainstream. And I think that really then helped show that there's all these different types of ways for startups to grow versus just the traditional venture capital. So I'll pause there. Tom, do you want to help me with some questions?
Yeah, absolutely. So we've got one here on what high level, what are your contract terms, like personal guarantees, volume commitments, covenants? Any comments you have on contract terms relative to personal guarantee, volume commitments, covenants?
Yeah, definitely. Thanks. And whoever asked that question, appreciate it. So first, the personal guarantees. We don't require any personal guarantees. We just don't. That's just something that we just believe in. So no personal guarantee there. And then for the volume, we definitely look for partners that can grow with us, right? So just one deal we're not going to, be really excited about. But if we can do multiple deals with your company in the future, that's something that allows us to get excited and also really comfortable with as well. So we'll really look for companies who have the potential for future business, the potential to that deal be able to scale over time, ideally with the same client or with different clients as well. That's fine. But we really look for someone who can provide us with enough capital to hopefully finance over the next 3, 6, 9, 12 months. We also do have to spend a lot of time, on a deal basis. So for us to get comfortable with a startup is great, because then we already are familiar with your business, your revenue, your income statements, et cetera. And so that allows us to make a decision even faster.
Follow-up question from same person, Walovec out there. How quickly can you make decisions, turn around funding? How does the diligence process work?
Yeah, so that's one of the benefits of working with an alternative financing company, is that we can make decisions very fast. So, we can usually move as fast as the startup wants us to, and we can finance a deal in as fast as a few days, or we can move more at their pace in a week to 2 weeks. But I'd probably say the fastest that we can do it is just about a couple of days. But what's really, I think refreshing for a lot of these startups is, finally speaking with someone who can move at their pace, because we understand, we've been in your shoes where these startups have these contracts and they're like, they have 1,000 things going on, and they need the capital by Friday. Okay, cool. We can work with you on that. And that's something that we're comfortable doing.
And then the diligence process was an add-on to that question as well. How does the diligence process work?
Yeah, so I'll keep it general just because I don't want to only talk about VendorTerm. But for a lot of alternative financing companies, I think they really want to understand your business and how it's operated in the past, but more so, your future business and your future roadmap. So I think for a lot of alternative financing companies too, we place a large amount of emphasis on the executive team. So there has to be a lot of trust. There has to be a lot of communication and transparency between the alternative financing company and the startup, because we're essentially giving you a lot of money, right? And we're obviously purchasing a receivable or some sort of collateral per se, but there still is a lot of trust, especially when you're giving a 6-figure sum, sometimes a 7-figure sum, to a 3 or 4 person startup, right? So I think a lot of alternative financing companies will ask for certain financial documents like income statements, financials, revenue, et cetera. And then also understand more about the current contract that you have, or the current PO or invoice with your client. But then also more about you as a company, you as a person, your insights, and as much communication and transparency as you can provide, I think will allow you to move those conversations further.
Excellent. Pat McClintock from the government side just commented that he often has to translate to industry, and was looking for a good way to explain it, and liked your vantage point. Pat, if you want to come off mute, do you have any follow-up questions for Ben related to your comment there?
And maybe you can provide some guidance on how to go about a problem that I'm facing that I'm super new to. So I'm looking to connect with kind of maintenance providers or folks who make purchasing decisions or financing decisions for different bases and government facilities that might have like giant concrete floors to sell concrete floor polishing equipment to, or services to. And I'm hitting a roadblock with like, how do I actually connect with those maintenance providers or the key decision makers who are responsible for those maintenance projects?
Yeah, definitely. First and foremost, I would say LinkedIn. I'm really bullish on LinkedIn in terms of business development and leads. If you look at our team, VendorTerm, and we're posting on LinkedIn every week. And the views and the amount of feedback that we get on those posts is tremendous. I'm amazed more companies don't do it. Then also, if you look at what AFWERX has been doing on LinkedIn, I think they'll resonate with a lot of stuff that I just said as well. That entire team is posting and is very active on LinkedIn, which is awesome. So to that point, I think you should take advantage of LinkedIn, connect with everyone there, and then shoot them all a specific note. It sounds like you may want to connect with someone in purchasing, or potentially in someone in the innovation arm. So I think finding those types of keywords on LinkedIn, what you can do is you can just type in innovation Air Force, innovation AFWERX, and then your other keywords. So maybe purchasing AFWERX, purchasing Air Force. Maybe you can focus on a specific base as well. Their website, the AFWERX website, also has a ton of information on it in terms of which briefs they currently have outstanding. I'd recommend you look at their website and potentially decide if you want to submit a brief. but definitely LinkedIn. I think it's huge, and I think a lot of their team is very active on it and would be open to respond.
And how does the kind of purchasing structure work for kind of like let's call it more commodity things within the Air Force? Is it base specific? Is there one person who's buying, you know, all of the different vacuum cleaners for all of the bases, and they're trying to keep it with the same supplier? How does that structure work?
Yeah, I can't speak to that, so I don't want to lead you astray, just because I'm not a part of the Air Force or for AFWERX. But I'm sure that there are people, you know, at the Air Force who, if you just say, "Hey, I have a question. I'd love to speak with someone and better understand, you know, the situation,
Roger.
and here's what I'm looking for." I think those people will be the best point of contacts for you.
Roger, appreciate it. Thanks so much, Ben.
Yeah, and
Definitely,
Max,
thank you.
I'm seeing in the chat, if you want to open up chat, Yamani is recommending the civil engineering squadrons at bases might be a good place to go. Also have another question here. How should a company vet an alternative financing business or option? Are there better fits based on geography or industry vertical? So how do we vet an alternative financing business or option, and how does that relate to fits to geography or industry vertical? Any comments on that, Ben?
Yeah, definitely. Thanks for the question. So yeah, I think, you know, for alternative financing, you definitely want to speak with at least 3 different companies just to get a better sense of what's out there. But before you do that, definitely look into what's online. There's a lot of really good resources online. Just type in alternative financing solutions. You'll understand, you'll see some of the larger players in the space. There are companies that are specific for industry. So for example, we don't do e-commerce. Largely because a lot of e-commerce is direct to consumer, and we don't do any direct to consumer deals. There are, however, a lot of really good alternative financing solutions who focus entirely on direct to consumer. So for that example, if you're a D2C company, you know, that's not something we would take a look at, but that's something the other company would take a look at in terms of industry. So there are very industry specific solutions. As for geography, so most companies in the United States will do deals that are US based. What I would be able to say in terms of our perspective, not from the other company's perspective, but we only work with US based buyers. So the large corporation, whoever actually owes the money on that invoice or PO, has to be US based. And then usually the startup has to be US based as well. So in terms of geography, US based, and then industry, there are a lot of different options per different industries.
Excellent. Anyone else? I don't see anything else in chat, but feel free to come off mute for a question for Ben.
So someone asked, how's it best to get the advisors and mentors who have a right background for your company? Yeah, so, you know, if you go to our website, you can see our advisory board. You know, that's something that I think is a huge benefit for startups, and that isn't leveraged nearly enough. So, you know, long story short, for your advisory board or for a mentorship or whoever it is, you really just want to get the smartest people that you know and have them somehow aligned with your company. So I think one of our biggest benefits is to have an advisory board that, you know, fortunately is consistent of a lot of CEOs, a lot of managers, a lot of people who have amazing experience and track record that I can lean on in different times. And the way that I've found these people is I've built up, you know, relationships over the years. It's not something that you can just build in a month or two. But what I think you'll find, and I think this is industry agnostic, is that really successful people want to help out younger people. And that's generally a good rule of thumb for, you know, whatever field you're in my experience, just reaching out cold to someone who, you know, someone who I look up to or find to be very smart and I admire them, you know, they'll give me 15 minutes of their day so that I can ask them questions. And, you know, they'll say, wow, this is a really hungry young person who's, you know, done his research and knows his homework because he looked me up and he knew which specific questions to ask me. That's awesome. I'll help him out in the future. So I guess I would encourage you to maybe come up with a list of 5 different people or so that you really admire, you know, in your specific field, that also have an experience that you know, can piggyback on your type of company and can really help your company. And then do your research, do your homework, look them up, you know, maybe read their book, you know, find an article that they recently wrote online, on Twitter, connect with them, on LinkedIn, connect with them. And usually more than not, you know, they'll give you 15 minutes of their time, if you've proven to them, you know, hey, I'm not just reaching out for a cold ask. You know, I've done my homework. I know what you can provide, and I'd love to get your thoughts on X, Y, and Z.
Fantastic. Yeah, getting some chatter on that question and that response, and wishing more people would take advantage of advisors. Pat, thanks as well for your comments.
Then I just got a few private messages for people asking me for my email address. So you guys can email me anytime. I'm happy to speak with anyone. My email is just ben@vendorterm.com. Just shoot me an email and I'm happy to help, with whatever questions or other insights you guys have.
I just put that in the chat as well,
Great. Thanks.
ben@vendorterm.com. Yep.
I guess maybe something else I'll just talk about is, just to bring it back to AFWERX. So, I think what's really interesting from a startup perspective is that you have an organization that's obviously associated with the government that is really bullish on innovation and bullish on working with startups. So, if I was a startup, I would be trying to apply to a lot of the different briefs that they have up on their website, which I think are awesome because they're very specific and well thought out. I would also be looking up everyone on their website and then connecting with them on LinkedIn and saying, hey, I really found your presentation or your discussion to be really exciting. I'd love to chat with you for 15 minutes. And then the third is on these types of panel discussions, I would find, or these types of discussions online, find people who are smarter than me, who are on the actual, doing the keynotes and doing the other workshops and the panels that are associated with the Air Force, and connect with them directly and say, hey, I heard you talk for those 15 minutes on Tuesday or Wednesday, whatever. That was awesome. My company does XYZ. Can you connect me with someone who potentially can help us? Like tying the dots back to where they are, I think is going to be really helpful for startups. So, I know it's tough. I can't ask the audience right now, who everyone is and what their background is. But if you're a part of a startup, the Air Force is basically like waving their arms like, hey, like we're here and we want to work with startups. Take advantage of that. That's not something you're going to find, not only in every country, right? In the United States, that's awesome. But in every government entity, that's not something you're going to find. So I think if you're a startup, definitely try to take advantage of this.
Yeah, and one way to connect as well is with the Small Business Innovation Research Program, SBIR, which AFWERX is closely aligned to. So there's focal areas that come out twice a year, and the contracting process is pretty straightforward. It's definitely tied to the Open Innovation Challenge process, which this Fusion event is kind of the ending point for all these Base of the Future challenges. But there's more to come. They're all advertised on the AFWERX site, as Ben just said. And you might want to look into SBIR, Small Business Innovation Research, as a funding mechanism. I don't know if that's considered alternative or not, Ben, but it's definitely a new funding mechanism that the Air Force is leveraging, particularly with startups and smaller companies.
Yeah, definitely. I mean, that's so valuable. And then, from a alternative financing solution, obviously, we love to see contracts that have the government because, the government obviously has a very strong credit, but also from a VC perspective and from an investment perspective too, to have a startup that has a contract, that has an invoice with the government. I mean, that checks off so many boxes, and it shows, that you have your stuff together, that you have a product that potentially can scale into massive areas of the government, that's generating revenue, and that you also know how to really, get everything together and dot your I's and cross your T's, because the government doesn't just work with anyone, right? So being able to show that kind of proof of business, I think, is really amazing. And then you can also leverage that to other clients as well in the private sector. Then you can go to corporations like, corporate XYZ and say, hey, we're working with the government. You want the same product? Great. Well, here's the cost and here's the price. So that's really valuable there. Just looking here in the message board question. So do you have perspective on where startups go astray in terms of business model? Yeah, I mean, it's a tough question to answer in terms of just because, without specific information, but I think, previously, kind of like from a macro perspective, a few years ago, a lot of companies weren't necessarily focusing as much as they were today on revenue generation, especially in the early point, because companies were able to raise large amounts of VC dollars on unproven business models. And now you fast forward to where we are today in a post-COVID world, I think as a startup, you really need to be able to demonstrate that you're generating revenue and that revenue that will scale as well. So I think being able to have a product that can start off in one specific industry and then scale from there is very critical. So I think if you're a startup, finding what product works in which industry and then doubling down on that is going to be really instrumental for your growth, rather than just offering it to all different industries and all different areas. Say that you want to focus first on transportation, or if you want to focus first on retail. Okay, cool. Well, then try to own that vertical and then replicate that vertical across 3 different verticals and then 9 verticals and then 12. Where I think some startups go astray is that they don't really have a point of focus, and instead they'll just talk to anyone and whoever will listen. But I think it's really important to have a focused approach, especially as a small, lean startup, to say, this is our focus, this is our goal, this is who our target customer is, and this is how we're going to execute.
Excellent. Another, go ahead. Somebody have a question? Follow up? Go ahead.
Yeah, because so I spent a long time in industry, and now I do a bit of teaching and coaching of really it's pre-startup activities at universities, and I just really wanted to see if that's what your sense was about where the world is going on that, because I think there was a lot of VC capital available for just anything, it seemed like. Then folks weren't very rigorous on their business models, right? And they would just spend that money till something stuck or they ran out, right?
Yeah.
And so this is really helpful to hear, because it's something I teach, because I've seen it for so many years. You know, I've got decades of experience, right? And so I've seen a lot of things not work, and a lot of money wasted. And it's really good to hear that you think it's pivoting in that direction of, no. You really have to have some viable way to get to revenue. And then, you know, path the market, path the revenue, path the profit eventually, right? And that's the kind of thing we're coaching and teaching. But there's still a lot of old messages out there about doing it the other way, right? And so anyway, I really found that perspective helpful. I'll connect with you on LinkedIn, so maybe we can chat further.
Yeah, please do. I'd love that. And then just to quickly touch on that as well, I think, you know, in a post-COVID world, I think that only will accelerate, you know, that idea and that premise too. I think especially from a VC perspective, it's tough because VCs just need to hit one home run and they can strike out the other 99 times, right? Like they don't care. They just want that one home run because that's their business model. But that doesn't work for every type of startup. So I think in terms of a general insight into the space, I think in a post-COVID world, you know, revenue generation, clients in a specific industry, and then to be able to scale that product or that service to other industries, I think is going to be very critical.
Great, thanks.
Another question there in the chat, Ben, around considering pre-revenue companies if they get a large PO from a reputable company. What's your sense on that?
Yeah, so if you mean by, you know, will we look at companies if they have their first PO? Yeah, we definitely will. You know, I think one thing that we definitely will look for in companies is their track record, and if they've been able to execute on those POs or on those invoices, that's very critical. So getting the PO is great and all, but you know, for some companies, they'll come to us and say, "Hey, we have a PO that's $500,000 from Corporation XYZ. This is great," and we'll say, "Yeah, that's awesome. You know, have you been able to execute on that before?" And they haven't. And so that raises some level of concern as well, because there's so many different variables along the supply chain and along this process where a deal can go wrong. And that just increases the risk from our side. And from our perspective, our CFO will say this as well, you know, we really want to find deals that have obviously the least amount of risk as possible, even though we have a relatively high level of tolerance for risk. So I think being able to show, you know, a track record of success, maybe starting off with a PO of 50K and then 100K and then 500K, you know, that'll really help not only investors, but alternative financing companies as well get very comfortable with your business model and the ability to execute.
Fantastic. We're down to about 4 minutes remaining, which could be a couple of awesome questions remaining. Anybody want to come off mute, and any follow-up questions, feel free to come off mute.
I'll put one out there. If you had to summarize, say 3 alternative financing methods that you might not have covered already, or that you think people are the least likely to find, which 3 would you bucket in there?
Yeah, good question.
From a keyword focus, like, hey, let's go Google this stuff and follow up on what you're saying right now.
Yeah, so I would encourage you to look at, first is invoice financing. That's first and foremost. Second is revenue-based financing. And then the third could be debt financing. So those 3 options will give you a good perspective onto the large 3 different options. You'll see how they're different. You'll see largely, you know, which startups they're focused for at which stage as well. But those 3 are probably the best ones to start with.
I just loaded those into chat as well. So invoice, revenue-based, and debt. All right, we're down to a couple of minutes. So if there's no further questions, Ben, any closing comments, thoughts? Again, I'll put your contact details in chat here for those of you who may have just joined. So look in chat for Ben's contact details, and floor back over to you, Ben, for a couple minutes of final comments.
Yeah, cool. Thanks so much, Tom, for all your help. I really appreciate it. And thanks so much to AFWERX and the Air Force for everything that they've been doing. I think I'll just leave you with a couple thoughts. One is, feel free to connect me on LinkedIn and email me, ben@vendorterm.com. Happy to chat and try to help out with whoever and just reach out for whatever you guys need. Second is, I would encourage you guys to take advantage of everyone who's speaking and connect them on LinkedIn and message them all on LinkedIn. AFWERX is super involved and active on LinkedIn. Take advantage of that. And then the third is, just constantly try to reach out to people in terms of, business prospects and for leads. So I think you'll be surprised at how receptive people are, especially in post-COVID world where everyone's basically working from home. People are very accessible and available to talk, especially with startups who have a unique service or product. Take advantage of that. Get stuff done sooner than later. Don't put it off, and try to speak with everyone and tell everyone about your idea and your company and your product, because eventually someone will find it, someone will buy it, and someone will help you guys.
Fantastic. Well, thank you, Ben, for giving us your time today. A lot of great questions. So thanks to everyone for joining. Ben, thanks again to you on behalf of AFWERX.